Hey, on the set, folks, I've got a real treat for you. Tyler McBroom, what's happening?
What's going on, Brad? Good to be here.
Folks, if you don't know Tyler, you will. He's a CPA, MBA, partner and CEO of Measured Results. He's a tax professional who loves to help his clients keep as much money as possible from Uncle Sam as they grow their businesses, which is important. Tyler grew up hearing his CPA father talk strategies with his business owner friends on ski trips, and now is putting that knowledge to good use. Tyler's partners with his father at Measured Results, which are CPAs, which was recently featured as an Intuit firm of the future.
That's right.
I'll be down.
QuickBooks.
You're also partners with Tony Robbins in the business mastery courses.
Yep.
Which is freaking excellent credibility, because I know Tony and he don't pick slouches.
That's right.
And whether it's discussing tax and business strategies or the fundamentals of personal finance, Tyler also has a passion for teaching others. He shares in his knowledge daily across various social media channels and conducts weekly in-person presentations in his mission to help make taxes and business concepts easier to understand, bringing taxes to the masses, as he likes to say. So you got a podcast, Tax Savers University.
Yeah. Mm-hmm.
And you got a #1 book out right now, Cashflow and Grow.
That's right.
If you guys want to follow him, at Tyler McBroom or tylermcbroom.com. Says your sister Melanie's in my closer school.
She is. Yeah, she was just out at your event last month.
Yeah, now I know who you are.
Okay.
I'm like, dude, I need to get to know this guy regardless, but now I know because she was talking a lot about you.
Yeah, gotcha.
Yeah, she's asking me how to close deals for you.
Uh-huh.
Yeah, like if now that I know this, like I'll really help her try to freaking close some serious biz.
Yeah, actually she sent me one of your posts that was a Q&A of asking one of her questions and going through the cheap, quick, good kind of triangle.
Yeah.
And getting over that.
There's 3 ways we do things.
Mm-hmm.
Fast, cheap, and good. You can pick 2.
That's right.
So when people say I want good and fast, well then it won't be cheap. I want cheap and fast. Well, then it won't be good.
Yeah.
It's a good one. So dude, here's the question I have for you.
Mm-hmm. Biden
and his new tax plans. When will those go into effect?
That's what everyone wants to know. When we're going through and say, okay, Biden is in office and we know that in general, historically, we have some of the lowest tax rates of all time. Everyone thinks taxes are high. If you go back to the 50s, kind of after the Great Depression and into World War II, the top tax bracket was 94%, actually, at the federal level.
How is that even possible?
Now, so it was a much higher income to get. This is right now the top bracket's at $400,000 of income. If you looked back at what it was then, the top bracket would be around $4 or $5 million per year of net income. So
yeah, but still,
there were like 80 different tax brackets, but it still is absolutely, ludicrous.
So if you made $5 million, you paid 94% into taxes?
So no, that's the marginal rate. And we can talk about, so I'll just explain that real quick. So there's 2 different tax rates. There's the marginal rate and the effective rate. And everyone hears in the media when they think tax rates are going up and suddenly I'm in the 35% bracket, that you all of a sudden have to pay taxes 35% on all of your taxes. That's not exactly true. So the tax bracket, let's say you're in at 150,000, it becomes 24%. And then at 200,000, it becomes 28%. Well, when you hit 200,000, it doesn't mean that suddenly you pay 28% on all of it. You just pay 28% on every dollar above 200,000.
Oh, okay.
The rest is at 24% below that, and then 15% and 10%. So it doesn't mean, so all these people that say, well, I don't want to make any more money because then suddenly I'm going to have to pay 50% on all of it. That's actually not true.
So it's non-retro.
Right. Yeah. It's elevated. So that's the effective rate is when you take all of your income across all of the brackets and average it out, which is always lower than what your marginal rate is, which is what you would make on the next dollar of income.
Gotcha.
And that's the tax bracket when you hear it's going up to 39% or when it was 94%.
What about capital gains? What's it going to?
We don't know on that. So they're trying to get rid of capital gains, which will change the game in terms of the real estate market and stocks and all of that. But we'll see what happens.
Will it ruin the game?
I think it depends on, so there's a thing called a 1031 exchange. It's a like kind exchange in kind of layman's terms, which means when you have a piece of real estate, if you sell it for a gain, you can roll that gain into a new property and then not pay taxes on it. Basically, you're deferring it, you're kicking the can down the road.
Yeah.
So if they eliminate the capital gains rate, but keep the 1031 exchanges, then I think it's gonna impact things, but not have a huge dramatic effect on the real estate market in general. If they get rid of 1031 exchanges and the capital gains rate, then I have no idea I have no idea what's gonna happen. It'll either make everyone just sit and hold on the real estate, which will drive the market even higher because supply would be lower, or it'll make everyone dump their properties before the tax law change. So back to your original question on when is this changing? When we look at when Trump got into office and they had this overhaul, brand new, Trump tax plan. It was actually kind of run through Congress, not just Trump, but that took in effect 1 year after he got into office. So he got into office in January 2017. All of the new laws came into effect at the beginning of 2018 because it took that amount of time to go, write the changes, put the 700 pages of tax code or whatever they got to update, and then pass it into law. So whatever changes are going to happen, it wouldn't be for 2021. It would most likely be for the 2022 year. So that's where we're looking constantly every month. Okay, what's coming out? And there's kind of one-off things like these PPP loans and everything that happened last year that made things very interesting. But in general, if we're looking at any major tax law and tax changes being overhauled, it would probably be the beginning of 2022.
So we're safe this year.
Safe this year, most likely, or at least safe for today. They could always pass something in the middle of the year, effective immediately, but in most cases, it's starting at a new year.
Out of curiosity, taxes affect the congressmen and the lawmakers, correct?
Yeah.
So whatever they pass for us, they abide by, correct?
Yes, they are supposed to.
Yeah, supposed to.
Yeah. They also have people that are, if they pass it, they probably know all the ins and outs, I would think. Yeah.
Do you feel like real estate was designed to get the wealthy wealthier?
I don't know if I would say that. I know so for a long time, we specialized in real estate. We had about half of our client mix was real estate professionals. And a lot of them started by, they had their $15 an hour job, and then they went and started selling homes on the side. And now they've got 30 properties and they're crushing it. And it's been maybe 5 or 6 years. So they certainly weren't the wealthy getting wealthier. Now I know there's plenty of tax code that helps the wealthy get wealthier. And that's just kind of the whole thing with success and momentum is if you've got momentum, you're going to keep pouring on and doing more of it. But I know a lot of people who started from nothing and got pretty wealthy pretty quick using those real estate laws to their advantage.
Yeah, like depreciation. I mean, people don't understand all of the benefits of real estate. It's like you get depreciation, you get tax credits, you get appreciation, you get freaking all these things that collectively.
Right. Especially if it cash flows.
What about, I'm starting a business, I'm making under 7 figures. What are some tips that like every business owner listening to this should go take a look at right away to make sure? Cause like, I'm sure there's a lot of people making a lot of mistakes. They're not smart enough to hire a firm like yours. So they're just paying their taxes.
Absolutely.
How much do you think, number one question, how much do you think the average business, 7-figure or less, overpays in taxes by not reaching out to a firm like yours?
Well, I can tell you real numbers actually. So we always do an initial tax assessment where we run through and kind of go through our process. And the average that they're overpaying is $38,000. Just in real historical data of what we do when we meet with, hundreds of business owners a month.
And what people don't realize is they're giving $38,000 to the government when technically they could have gave you 10 and saved 20.
Yeah, absolutely.
Because I was been told, I think Tony said this to me. He said a CPA a good one never costs you money.
Absolutely. They should always be a profit center for you. And if they're not a profit center for you, whether in terms of saving you taxes or finding more profits in your business, more cash in your business, then they're the wrong CPA.
How do they do that?
Well, number one, on the tax side, it's just thinking proactively and looking at your business and saying, okay, what are some, tax strategies based on your situation that we have available for you? For example, if you've got kids under 18, the IRS says there's a rule that says if you pay your under 18 children from a sole proprietorship, then you don't have to pay payroll taxes on those wages that you pay them. And that child can earn up to $12,550 in a year tax-free. And now you have to actually they have to justify that wage. So they have to do something for the wage. So a lot of our clients, when they're first coming to us, say, well, I've got an 18-month-old. How can I pay them $12,000 a year? Well, a lot of money is made on social media these days, and people love doing business with a family man and a family woman. And so there's a brand to sharing your family out there. Can you hire your kids as models for your social media and website? And we did some market research, and we have a client who has like model children, and they get paid $500 a shoot. So you set them up on a monthly retainer for a couple shoots a month, $12,000 a month, $12,000 a year, tax free. And, we had one client who had 9 children. This worked pretty well for him. $12,000 times 9 children is, almost enough savings to buy back his sanity of having 9 children.
And that's under 18.
Under 18. So there's other things that you can do if they're over 18, like setting up corporations in their name, moving money into it, and hiring them out to do that. And those are things where it makes sense to talk one-on-one based on your specific situation. But that's one specific example of thinking proactively instead of just, hey, I've got my business and my expenses are what they are. Well, let's see, you want to map out your whole family tree, map out, do you own your home? There's a rule that says you can rent it up to 2 weeks a year tax-free if you own it. It's called the Augusta rule. And it's called the Augusta rule because every year when the Masters golf tournament comes to Augusta, Georgia, everyone who lives there clears out of town because they can get a pretty penny renting out their home. And so the IRS says, well, if it's under 15 days a year, it's your home, you own it. You're not really in the business of renting, so we'll just give it to you tax-free. So what you can do as a business owner is hold a monthly shareholder board meeting at your house, and you have that meeting with me, myself, and I, and you rent the use of that house out to your business for that meeting.
For how much?
It's what could you rent it out for a wedding or for a conference based on the size and value of your home. So kind of 2 ways you can do it. Number one is you go out to find a few conference rooms in your area at local hotels and find out square footage conference room that's about similar to the common area of your home. See what they're charging and use that for your going rate. A simpler way to do it, and kind of rule of thumb that we say, is 0.1% of the value of your home per meeting. So what does that mean? If your home is worth $500,000, you do $500 per meeting times 14 meetings per year is $7,000 tax-free out of your business, just for cutting a few checks. And you're already thinking about business at home anyways all the time. So now we're just getting some tax-free money for doing that by strategically using the tax code to your advantage. Now we've got some people in New York and the Bay Area, or our wealthier clients, where a Cracker Jack box is $2 million in San Francisco. They're getting some, good chunk of change out of their business by taking advantage of this strategy.
What about during COVID when everybody had to go home? Were you allowed to go upgrade your home with new TVs, new internet connectivity, new computers, new cameras, new headphones, new microphones, et cetera?
Yeah. So that would lean towards more of the home office deduction. And with the way the home office deduction works is if you've got an exclusive area in your home that's 100% business use. Let's say this studio was in your house, and we look at, obviously this is exclusively for business. We take the square foot of that room and divide it by the square footage of the whole house. And that's the percentage of your utilities, any home improvements you make, any, your mortgage interest or your rent. If you rent your home, that's the percentage that you can take. So if it's a 200 square foot room and you've got a 2,000 square foot house, then 10% of all of those improvements and all of that would be deductible. Now, if it's new headphones, new computer in your home office, those are 100% for your business. So those would be just ordinary deductions against your business.
Damn. See, people miss this type of thing. You know, they're dealing with an old computer. They don't realize you're going to give the taxes to your government. You might as well buy a new computer.
Yes. Although to that point, I will say everyone thinks because it's a deduction that it's free money. It's really, you're getting it on sale. So you never want to spend $100 to save 30. So going out and buying that, say $2,000 new computer, depending on your tax bracket, will probably save you around $600 in taxes. You're still got to spend the $2,000 to get there. So you're still out $1,400. So I would say if you want to buy it anyways, like if you want to go get that new Ferrari, go get it. But if you're going to buy it anyways, but don't just buy it for the tax deduction.
Yeah,
because,
of course.
It's just like when you go to the store, at Black Friday and you can't afford not to buy that dress that's on sale or that new suit that's on sale. Well, you still got to pay for it. You're just getting it at a discount.
What about when people call and say, hey, my CPA said I needed to buy a jet or I needed to buy a house or I needed to buy this? Why do people need to buy expensive shit when they're making a ton of money?
Well, the reality is most people, especially if they're making a ton of money, hate paying taxes. And so if it's a matter of spending, $100,000 on a new car or $1 million on a new jet versus sending a couple $100,000 to Uncle Sam, they'd rather take that new jet. And so needing to buy it was probably it would be more of a timing situation of, I've got to take this, make sure this is done before December 31st so that it falls into this tax year versus if I wait a couple weeks, then I don't get the deduction this year and I lose out for a whole nother year. And time is money, right? Time value of money. So having that cash right now is important.
Do you have clients that you advise like that?
Yes. And it's always with that kind of make sure you actually need this or, that if you really hate paying taxes, this is a way to do it. It's up to you if you want to be out that cash. But if you buy it financing, so as a perfect example, I bought a car before the end of the year, a new Tahoe, and I bought it, put a couple grand down, financed it. So I get, because it's a vehicle over $6,000 or 6,000 pounds, I get to deduct 100% of that purchase price, save probably $25,000, $30,000 in taxes. I put $2,000 down and I'm paying $700 a month on, or, more than whatever the payment is. So from a cash flow standpoint, I came out way ahead by buying that now and financing it. So, because cash flow matters too.
Yeah.
Right.
Dude, this is some, I wouldn't say complicated, but pretty, complicated things. Like the average Joe doesn't know half of this shit.
Right. That's why they hire people like me.
But why? There's a lot of people that don't though. I know 1 million entrepreneurs. They don't have a good CPA. They go to the end of the year and they say, here's my QuickBooks, and the CPA literally fills out the paperwork and sends it in. They don't say, hey, you should have done this for next year. Do this instead of that.
Yeah.
Like our CPA here at Lightspeed, they just simply fill out forms, really.
Yeah. And that's the most common complaint we get about people who come to us and, my guy's just filling out the forms, or it seems like he's working for the IRS.
Yeah. So when people hear this, they're going to be like highly interested. Number one, Tony Robbins don't work with slouches. So obviously you're good there. You've got Firm of the Future coming out. Your book went number one. So obviously it's good. If all these people listening said, man, it'd be worth it to get a hold of this guy and have him do business with me. What is the average cost per year? When does it make sense?
Yeah. So I say whenever someone comes and says, what does it cost to work with you? I always say, well, what does a bag of groceries cost? It depends if you have the ground beef or the filet mignon in there. So there's a lot of different services we do. So it really depends. I'd say, kind of starting at $8,000 a year is like the kind of minimum investment, but and we were talking about this before, it doesn't cost anything to hire us because we're going to be a profit center for you. And we actually don't take clients on unless we can be a profit center for them.
But there has to be a level that they have to be at.
In terms of their business?
Yeah.
Usually I'd say we start working with businesses once they're netting around $200,000 to $250,000 a year.
Then it makes sense. Before that, there's things you can do that
that will save you taxes. And I give them away for free on my Instagram every day. But in terms of working with us and kind of going and deep dive on creating an actual plan, usually in that 2 to 250 net income range.
So if you guys are listening, you're making 250 or more net, it might be of interest to reach out, tylermcbroom.com, and check it out. Is that where they go? Yeah,
they can go there.
Yeah, because I'm already thinking, okay, I'm going to hire you for my new company for sure. Why? Well, it hasn't made a bunch yet, but it's going to. And I want to get situated and set so when the money starts pouring in, you're guiding me to maximize. Because again, I mean, dude, if you said, hey, now this is a little shady, I don't do shady shit.
Yeah.
Period. Like my freedom is worth all the money.
Absolutely. And everything's a deduction until you get audited. And that's when the rubber meets the road. So we want to do things that are like that. We're going to save you taxes, but it holds up if you get audited or ideally, we set you in a situation where you're not going to get audited because we structure it the right way.
Do you handle the audit if someone were to get audited?
Oh yeah, absolutely.
Yeah. Cause another thing, we got audited like maybe 2 years ago. Well, the CPA I had to pay to handle the audit. And I'm like, well, you're the one doing all the filing. Why wouldn't you just handle it?
Yeah.
But I had to pay extra. They did handle it. Not one dime was out of place. They came for like 2 months, sat here in the office, going through everything.
That's a fun process, huh?
Yeah. Well, I didn't deal with it, thankfully.
Yeah.
But 2 months later, I said, what's going on with it? They said, nothing. They left. Well, what'd they find? Nothing. Everything was fine. Zero.
You just had the luck of the draw, huh?
Well, what does that mean? That means we probably overpaid. Why? Because if they didn't find anything, they probably said, this guy's paying more than he's supposed to.
Yeah.
And I bet you money I am.
Yeah.
So I should have hired you last year and the year before and the year before for light speed.
Yeah.
So after this, dude, I do want to have a better conversation because I'm thinking about you. I'm definitely going to use you for my new business.
Yeah.
And by the way, do you guys help people figure out how to structure shit? Yeah,
that's all part of what because proper entity planning is huge for making sure you're structured correctly. Also for potentially managing not getting audited because different entity types have lower and higher audit rates. But now sometimes you need to be one regardless of the audit rate. But like an S corporation, for example, is a 1 in 250 chance of being audited versus a C corporation kind of slides between 1% and 3%. And then if you're just a sole proprietorship or a single member LLC, it's about 2.5%. So
what does that mean? What's the best one?
Well, 1.4% S corporation, 1 in 250 versus 1 in 100 chance of being audited.
So you want to be an S corp if you can.
Yeah, and now it depends on if you're.
What if I'm an LLC filing as an S?
That's fine. That's the same thing. Now we want to look at. On the lower income side of things, in most states, it makes sense to elect to be taxed as an S corporation when you hit around 70 or 80,000 in net income. And then on the higher side, once you get into a couple $1 million of net income, then sometimes it makes sense to switch to C corporation. Sometimes it doesn't. And that's again where it makes sense we want to run the numbers side by side and actually look at your situation.
And you do that for people?
Yeah, absolutely.
All part of that fee? Yeah,
absolutely.
Damn.
So it's one of the most important things you can do. And, because as Tony Robbins says, your two largest expenses in your life are either hopefully you don't have to deal with getting a divorce and then taxes. Those are the two largest expenses.
What about like QuickBooks or keeping track of the inbound, outbound?
Yeah. So having a good set of books is actually, everyone always asks, what's the best thing I can do to lower my taxes? And they want some sexy thing like the Augusta rule, free meeting rent. Let's go, rent a Ferrari, all those like kind of cool things that you see online. The actual best thing you can do to lower your tax bill is the fundamentals. And that's keeping a good set of books.
Now that new LLC, I don't have books. I have a bank account.
Okay. So a bank statement is not enough when it comes to documentation if you're trying to actually have deductions and have it hold up in an audit.
Yeah. Well, that's why I'm going to hire you. Yeah. Cause I don't have, I just started it. So there's nothing major yet, but I'm going to plan on making it major. Mm-hmm. Number one, I just created a shell thinking, well, this will own this then. So now I own part of a RV dealership and now, I own half of the RV dealership that's making money every month. Mm-hmm. Just bought that not too long ago. Well, I put that in that LLC's name. I want you guys to go, don't do that.
Yeah.
Like, do this. And then I'll go get it all done to where eventually when someone calls me, I say, go call Tyler, bro.
Yeah.
I don't know. I don't know.
Right.
Is that what you do?
Yeah. I mean, that's part of it. And on the LLC thing, just to answer a question that a lot of people ask and are wondering, an LLC, actually getting an LLC isn't a tax strategy. It's a liability legal strategy. It doesn't help you save any taxes. Now, being an LLC taxed as an S corporation does, or LLC taxed as a C corporation does. And so when you mention RV, putting it in a different, all that kind of stuff, that just made me think of that. So I just wanted to mention that real quick.
But how do you take as much time with that low of a fee? $8,000 a year. Shit, dude. Like I'd take that just in trying to get me to understand shit.
Right. Well, and that's where I mentioned the bag of groceries. It depends on, if we're meeting every week or every month and, diving deep and you've got a bunch of different entities and moving a bunch of things around, then it's higher than that.
Well, like, do you go through the bank statements?
So we have a whole team of bookkeepers that does all that
for me,
for you. Yeah.
So,
exactly.
So if I'm using a debit card, cause that's all I use,
yeah.
Debit or credit. I always thought the bank is that there's the proof. Why? Well, because if the money went in, it went there.
Yeah.
And if the money went out, it went out from there.
Yeah.
Look, there's what I spent. There's what I made.
Here's why that doesn't always work. So, and why you need copies of actual pictures of receipts. And you can do that with technology these days, super easy. But let's say you go to the Chevron station and you fill your tank up and it's $75 to fill up. And you think, well, it says Chevron on the bank statement. Of course, that's fuel expense for my car. Well, if you get a nasty auditor that gets getting aggressive in there and they see that Chevron has a Quickie Mart attached to it, they can say, how do I know you didn't go in there and get 4 cases of beer with that $75? And then they throw it out because it's not a legitimate expense.
Now, if that ever happens, by the way, because I always thought to myself, if you get audited, you're not in trouble. They're just going to say, sorry, you owe us more money.
Right. Mm-hmm.
That you don't get in trouble.
Well, they look at intent.
Yeah. Well, intent is what? Like,
so
I know what intent is, but like
spending $75 getting 4 cases of beer on your business credit card, and it accidentally gets classified as fuel because your bookkeeper sees Chevron in there. You're not willfully trying to hide money.
Yeah.
If you send out if you have money that comes in let's say 10,000 cash and you stick it in a drawer and it doesn't get put on your tax return, that's pretty obvious that you tried to hide that from getting put on your taxes.
Yeah. Well,
that's the difference.
But not many people probably trying to do that, are they?
I mean, you'd be surprised, but most people, but for the most part, in terms of having bank statement versus receipts, you're not going to get in trouble for fraud or anything like that. So you just might lose your deduction.
Yeah. So should you just like take pictures of all the receipts?
Yeah, you should.
That's it though. A picture sign.
So the most common one would be meals. That's an easy example. So a meal needs 5 items to hold up in an audit for a business meal. And you need to be meeting with someone kind of as a foundation, or you can be traveling and eating by yourself. But the 5 things, the first 3 are on the receipt, and that is the name of the restaurant, the date of the meal, and the amount. And the last 2 are not on the receipt, and that is who you met with and the business relationship of them, and what you discussed that was the business reason for the meeting. So best practice, and it just takes getting into a habit. It seems like a pain at first, but if you just write those 2 things down on the receipt while you're signing your check, and then snap a picture. The simplest version is just pull out your iPhone and snap it on your photos, and it stores it on the cloud. But best practice is if you've got QuickBooks, and most accounting softwares on the cloud have a feature today where in the QuickBooks app, you can pull it up and it has a receipt. Take a picture of the receipt. You take the picture, it scans the vendor, scans the amount, plugs it into your books, and auto-categorizes it for you as a meals expense, or
really?
as a computer expense, or as an office expense.
And/or asks who is it with, et cetera, et cetera.
It doesn't ask who's it with. That would be you'd scribble that down before you took the picture.
Yeah, because my thought is, if like I hired you guys, I still have to do QuickBooks, don't I?
You still have to. You still have to take pictures of those. We can't do that if we were to do that for you, that'd be very expensive.
So,
You know, walk around, you know, you still have to save your receipts.
Well, let's say like, for example, I want to go to St. Thomas.
Yeah.
I have a client who's also my friend.
Mm-hmm.
I say, hey, let's go to St. Thomas. I spend $10,000 going to St. Thomas, but my friend, who by the way is also a client, came with me.
Mm-hmm. And
at the pool, I said, hey, you want to buy some more production? And he says, no. And I say, okay, thanks.
Uh-huh.
Is that now a business trip?
If he's a client of yours, then it most likely would be. So you want to do business with friends. Business with friends is a great way to. I mean, I had a ton of clients who are friends. It's great. And prospects who are friends actually work too, as long as they're legitimately prospects. We want to have legitimate business relationships here. And to that point about going down to St. Croix, number one, it depends on the fee they're paying you. If it's a $500 a year coaching fee, which I know that wouldn't be your fee, but like spending 10 grand on the chance at someone who's paying you $500 a year isn't going to hold up to snuff.
Yeah.
It's got to be ordinary and necessary. Now, someone who's paying me 200 grand a year to be a coach, fly them out for a $10,000 expense to have that one-on-one coaching with them, or the chance at a $200,000 engagement, I'll pay that every day of the week. So that's ordinary and necessary.
Well, let's say my buddy says, hey, come out to St. Thomas and speak at my mastermind. I'll pay you $25,000 to speak. And I say, okay, but it cost me $25,000 to go. Is that completely deductible?
Yeah, absolutely. So now, the flight, the hotel, the meals would be deductible. Entertainment is no longer deductible.
Alcohol, no.
Alcohol is. Alcohol counts as a meal.
Okay.
Now, again, ordinary and necessary. So if you're having a couple glasses of wine together, that's ordinary and necessary. If you're lining up 15 shots of Jaeger, would depend on the nature of the relationship. That might be ordinary and necessary, and
that's if you get audited.
Right. If you get audited.
Because if I turned in 15 shots and said, hey, write that off, you'd say, that's where they say, well, you, the IRS, bitch, like just write it off.
Here's the thing. We don't actually look at every single receipt you have. We're educating you on what counts as a deduction. And if you're not sure, you call us up and say, hey, how do I make this deductible? But we don't pour through every single receipt. That's on you to keep those receipts. And we're assuming that, let's say it's the 15 shots of Jaeger. Let's say that costs, $120. If we see $120 at the hotel restaurant, that's not going to be an abnormal receipt that we would even question. So it's on you.
But a private jet for $60,000 would.
Yeah, we'd want to talk about that one to make sure. Okay, let's talk about the transaction here. Who was there?
Well, because I know a company that just did it.
Mm-hmm.
They brought me down there in their private jet that they rented. They spent like $200,000, but they brought some of their top producers.
Yeah,
and they had a mastermind,
mm-hmm.
which I spoke at. Another guy I know spoke at. So it was legit.
Yeah,
but this guy was getting film of the mastermind, and I said, "What are you doing all that for?" And he said, "Oh, just in case. You got to prove that this happened."
Right. Well, and that's where sometimes abnormal things like that do increase your chances of getting audited.
Sure.
And that's where, before you do it, you don't want to have that, oh, you did conversation with your accountant where after the fact it happened and we didn't plan in advance. You want to say, okay, I'm going to do this. Let's make sure we cross our T's and dot our I's.
Yeah.
And so that's where you'd look at the situation and say, okay, this is $150,000 of expense. It's going to save me 60 grand in taxes. It might increase my audit risk by a couple %, but I'm willing to take that risk because I know it's legitimate, and it's 60 grand in taxes. So that's not a small number.
What about when you have insurance that you can borrow against?
Mm-hmm.
Like, I forget the exact way they were doing it, but someone told me, Brad, if you go fund $2 million pre-tax into this type of insurance,
mm-hmm.
then you borrow X amount of dollars from the insurance. You don't owe it back until you die, which means basically you can get that tax free. And I'm like, there's got to be some, like, the IRS isn't stupid. Okay.
Sure.
All your little tricky bullshit, people are in jail for tricky bullshit.
That's absolutely.
But he said, no, this is legit as it can get. And a lot of rich people do it. And what they do is they basically put all the money pre-tax into some sort of insurance, and then they borrow against the policy, which is tax-free.
Right.
And then I said, well, when do they pay it back? He said, when they die. And I said, so they basically just lived tax-free. And they said, dude, a lot of rich people live tax-free.
Well, how that works, and we don't need to go down the rabbit hole of life insurance, but how that works is you take a loan out against the cash value. So it's got to accumulate cash value first in like a permanent policy or an indexed policy. So it has cash value, and you pull that out in a loan. You actually pay yourself interest back into that. So it's basically paying yourself interest. And when you die, you don't pay it back. It just reduces your death benefit. So let's say you had $2 million of benefit and you've taken $600,000 out of that. Well, you get one, and then you kick the bucket, you get 1.4 instead of the full 2 million. So that's how the life insurance company is made whole.
Do you guys study stuff like that?
Yeah, we do. And we actually do some insurance planning and cause that works right in tandem with tax planning and your accounting. And I actually did a poll on my Instagram stories a couple of years ago and said, hey, if you could have all of your financial planning done in-house with your CPA and it's in one spot with someone you trust, would you prefer to have that? And it was like over 80% of people said, yeah, I'd love to keep it in the same spot. And so that's kind of where we've started going towards that route.
What's the average net worth of your clientele?
I mean, that's really, it depends, but I'd say, our sweet spot is kind of that small business owner, closely held business owner where they've got a couple $1 million up to, $20, $25 million business. So I'd say anywhere from, right at new millionaire to 20, 25 million net worth is kind of what the majority of our clients are.
And how long have you been doing this?
I've been doing it for about a decade.
What about Dad?
Dad started his first firm when I was 3 months old. So I've been actively doing it for, about a decade, and then off and on before that up until I got real serious, because my degree is actually in creative writing, because when Dad was an accountant, I did not want to go put numbers in a box for a living. So I went and got my degree in creative writing. And then I got tired of being broke and realized that accounting wasn't such a bad career. And then as I got into it, I realized that it actually does provide real value to people. And there's the first few years of putting numbers in a box, but now I just talk to people all day long, and it's, you really are changing lives. So technically I've been doing it for about a decade, but I, grew up as, in the bio, I was always on ski trips and stuff like that with my dad's friends who were clients.
Tax deductible ski trips.
Absolutely. And so been growing up in it. Do
you take advantage of all the loopholes?
Yeah, I do. It depends on ebbs and flows, depending, like right now we're moving to Florida, get out of California. And so one of the things that from a tax planning strategy is we can bring your taxes down to nothing. But then if we tax plan you into the poorhouse, you can't even qualify for a car loan, let alone a house loan. And so I'm on a pause button right now because I'm wanting to go buy a home in terms of like my strategies. I of course use some of them, but yeah, we definitely eat our own dog food and take advantage of that. And I've got a video about a Hawaii trip that we took that was a partner retreat a couple of years ago, and the agenda we have, and it's all that good stuff.
Good. So, now the book Cashflow and Grow.
Mm-hmm.
What's obviously it sounds like it's an investment book, but is it a tax strategy book?
There's a portion in there that there's a chapter on taxes, and it's not an investment book. It's more a book about the financial habits and routines that you need in your business to grow a financially stable business. Most business owners were really good at either building their widget or really good at delivering their service. And then they got an entrepreneurial seizure and went and decided they wanted to be self-employed. And they have no idea what it means to keep your books, to do tax planning, to set KPIs, key performance indicators, to have dashboard monitors so you understand how your business is financially healthy and how much cash you should have in the bank and what should your planning schedule look like throughout the year. And so really the purpose of this book is to, in a simple way that's easy to digest, it's not a very long book, in a way that's easy to digest, to understand how to run your business from a financial point point of view.
I'm going to get that book. Where do they get it? Anywhere books are sold?
So actually, if they go to tylermcbroom.com/Brad Lea, they can get it for free. If they just cover the shipping, I'll give it to them for free.
Oh, no shit.
Yeah.
All right. I'll go there.
Yeah.
Nice.
There you go.
Well, the reason I'm asking all these things, because again, I mean, I'm that entrepreneur. Like, you know, I know that every dollar that's ever came in Lightspeed is in QuickBooks, and every dollar that's ever left is in QuickBooks. So that always makes me feel good. Well, finally got audited after 20 years and it was all good. So I guess I did right, but I just hire a bookkeeper. You know, these are, you know, $5,000 to $8,000 a month people that, you know, when bills show up, they, you know, run them, and when payroll and all that, they just run them.
Right.
Do you guys, how does a part-time CFO work?
Yeah. So there's bookkeeping and then there's CFO. So it's kind of similar to there's filling out tax returns, filling out the forms, and then doing proactive tax planning. So bookkeeping is the filling out the forms version of keeping your numbers. The CFO work is the kind of proactive tax planning piece. So what we do as a CFO, as a kind of fractional CFO, and there's, you know, packages down to where we're just meeting once a quarter, once a month, and then sometimes, you know, once a week, depending on the needs of your business. But what we do is we start by doing a deep dive on, okay, where's your business now? Where do you want to go in your business? Not just on business growth, but profit. What do you want out of your lifestyle? And then we start with benchmarking you against your competitors, because most people, they have no idea how much they should be spending on payroll, how much they should be spending on marketing, on office rent. But if we can take your numbers and benchmark them against what the best in your industry are doing, then that gives us a roadmap to say, okay, let's set profitability metrics of how much money should you be making based on what you're bringing in the door. So we set those goals. We establish your KPIs, which are your key performance indicators. And what that is every business has 3 to 5 key numbers that if you obsess on improving them and getting them better and just monitoring them every day and every week, your business will do nothing but explode. So like let's say you're in sales, one of those is leads, right? So if you get enough leads in the door and then have enough conversations on the phone or on Zoom or whatever it is, you're going to close, and that's going to lead to success. So as part of our CFO coaching, we identify what those 3 to 5 key metrics are that really drive and move the needle on your business. And then we set how much, you know, profitability benchmarks, meaning, you know, let's say you're bringing in $1 million. Do we want to bring in $300,000 of profit, $200,000 of profit, $400,000 of profit? And then we monitor that on an ongoing basis. And then you get access to basically your dashboards that'll say, okay, you're green, you're crushing those metrics, or you're yellow, we need to improve it a little bit, or you're red. Okay, something's going wrong here. Let's talk about how we can fix that, whatever area is broken.
You guys have like shared software that your clients and you log into to see these dashboards, or you just report?
Yeah, no, it's actually shared in real time, and it links in with your QuickBooks. So when you add an expense in your QuickBooks, it updates to your dashboard like that.
Damn.
Yeah.
Dude, this sounds like a no-brainer.
Yeah, I mean, it's amazing whenever we, you know, dive in and go deep dive and find out, you know, number one, just knowing, am I spending the right amount of money on these different expenses? It's like, it helps them sleep at night so much better. Even if it's off, at least now we have a plan moving forward. And it's actually a super rewarding thing to do, to work with business owners who have never even really thought about they're doing the whole bank statement thing, you know? And so getting to where they're actually analyzing their performance of their business and seeing it track and seeing more cash in their bank. That's why it's cash flow and grow, because we want to grow your business. Yes. But you know, we go to these masterminds and these different business groups, and what's the metric that everyone's comparing themselves against? It's always revenue. My revenue is up 40%. My revenue is up 80%. They might have no cash in the bank and they're not making any money, or they're losing money, but they're bragging about their revenue growing. Where what really matters is, yes, revenue matters because ultimately it covers a lot of sins and it drives growth, but it's not just what comes in through the top line, it's what comes to the bottom line, and what do you have in cold hard cash in your business. Because most people start a business, yes, they like what they're doing and they're passionate about it, but they also want it to fund their lifestyle. And so many business owners go way too long without taking a paycheck out of their business. And if they start from the beginning with metrics and KPIs and actually monitoring the habits and routines that I talk about in the book, then they're going to be able to take a paycheck out a lot faster.
I've been forgetting the bombs. So, folks, you guys better be paying attention. What are top 3 things every business owner listening to this should be thinking? Like tip-wise, like, man, go check this, go check this, go check this.
Yeah. So first and foremost, actually have a set of books. Everything starts from there.
Would you recommend QuickBooks, starting somewhere else? We
like QuickBooks because what's nice about QuickBooks in the online version, not the desktop version.
How much is that a month?
They're actually, I think it starts at $20, $25 a month, and then upwards, and then kind of the average package is $50 a month, and then the package that includes all the financial dashboard software is $180 a month as of right now.
So if I went to that new LLC I formed, I go to QuickBooks.com, sign up for it, $180 a month. Now I swipe my card. I can link it to where it all tracks everything.
Correct. And we actually get wholesale pricing for our clients. So you get like 30% off. Just so if you don't have QuickBooks yet, I'd say talk to your accountant and help them set it up for you because they usually can get it cheaper.
Yeah.
But what's nice about that is we can click between all of our clients' books at a moment's notice and see in real time. And so be able to pull that up and kind of talk through the numbers. And so having a set of books, because without books and accurate numbers, we can't do CFO work, because if you don't know your numbers, how can we know how you're tracking your profitability? So that the foundation matters there. And it matters for the tax planning side of things too. Because I've had so many clients that come in, and when we get to the end of the year for tax planning, or they're meeting me for the first time, and I say, how much are you making? And they tell me their revenue number. So I'm making $500,000 a year. And so there's different strategies available to you if you're making 50,000 versus 500 versus 2 million of net income. So we'd set up all these strategies, and then we get, because they're sure that they're making $500,000. And then we get to tax time. We have to do your books because we're signing on that return that it's accurate. So then we do their books. Turns out they're making $150,000. Well, and then they can't qualify for a house or buy a car, or and then they wasted money on tax planning strategies that they didn't actually need. And so it's the foundation of your business, and it's also the first transition from kind of being someone who's in the business of whatever it is you do, to being an owner who happens to own a business that sells whatever you sell. Or, because then you're making decisions from a financial standpoint. You're not just kind of flying by the seat of your pants and saying, I think we need this, I think we need that. So starting with the foundation of a set of books. The next thing I would say is meet with your CPA before year end to run numbers for tax planning. Most people think that the time of year to meet with your CPA is February and March. Tax time, just watched the Super Bowl. I saw the TurboTax commercial. Better get my shoebox of receipts and all my tax documents and go drop them off on my accountant's desk. And then they're going to fill out the forms and tell me how much I owe from last year. That's actually the least effective time of year to meet with your CPA.
Because they're busy?
Because we're busy, we're stressed out, because everyone thinks it's the time of year to meet with your CPA. But we're also just filling out, we literally are just historians at that point. Because I always say once the ball drops in Times Square on New Year's Eve and Ryan Seacrest wishes everyone a happy new year, there's nothing we can do to impact your taxes other than say, max out this IRA for $5,000. And we need to meet before year end so that we can run numbers and say, okay, if you do nothing, then your tax bill is X. Let's do these 1, 2, 3, 4, 5 action items, and your tax bill is Y. It's 10,000 lower, 20,000 lower. We've got some clients that they came to us and we dropped $15 million off their taxable income. And that's significant in terms of their ability to grow the business, because when most businesses, when you grow, growth sucks cash. It just does. You've got to hire people. You've got to build infrastructure. You're growing your top line, but you're reinvesting in your business. So if you can take $50, $100, $250,000 of cash that would go to Uncle Sam and keep it in your business to hire more people or to spend more on marketing, then you do that every day of the week. And that's the thing. Most people, the media likes to tell you that these business owners, they save taxes to go spend more money on their lifestyle. Most of them, they save taxes to reinvest it in their business, to grow faster and to reach more people. So what tax planning does is it actually drives the economic engine of the United States.
Yeah.
So number one is having a good set of books. Number two is tax planning. And then number three, I would say get a CFO even from the beginning, but just kind of breaking that down smaller within the CFO realm of what we do. The best thing that you can do as a starting point is to get your industry averages for your company. So, because that will give you a benchmark of how you're doing from a financial performance on your business, and it'll give you a roadmap. If you don't want to spend a couple grand a month on a CFO, you can spend a grand or two getting access to your industry average numbers, and then you can kind of work your way through your own kind of budget and roadmap. But if you have no idea what the rest of your industry is spending on the big expense items, then you're just kind of, throwing darts on a wall and hoping that you're, investing in the right things.
What's the number one most advantageous career? Like I was telling you, technically, I don't call myself an influencer, but you're actually also an influencer.
I guess you could say that. Yeah.
Well, I looked at your social media. You got a bunch of followers.
Yeah.
So I'm an influencer, and I'm thinking, if I'm an influencer, isn't that an advantage? Why? Well, shit, dude, I gotta pop bottles and live the life to attract these people. Cause dude, there's literally social media millionaires making money, showing themselves living this lifestyle in order to sell their courses and their bullshit.
Yeah. Oh, absolutely.
And in my mind, I'm thinking, dude, that's kind of a cool little niche. Why? Well, because dude, you get to live the lifestyle because technically that's a write-off. Why? Because it's legitimate. That is necessary. Nobody follows losers. Nobody buys a course from freaking broke people.
Right.
So it's like, hey, I got to take this private jet. I don't really want to, but I got to.
Darn, twist my arm.
I got to have a camera guy follow me around. I got to go to these exotic locations so they can see me in these lifestyle elements, so they buy my courses.
Right.
So like that as an example.
Yeah.
What's the most advantage tax-wise? Or,
sure.
You know what I mean?
Well, and to that point, that's kind of a new era of business deduction in terms of, I know there's going to be some court cases.
Yeah, but they can't argue
come out.
It's true.
Well, and that's going to be a very expensive lawyer is going to go get fought to argue that, because if I'm just standing on a boat, popping bottles, taking pictures by myself, technically, if you look at the traditional model of business expense, that's not really a business expense.
So what?
But you can justify and make the argument that it is. And that's certainly, someone asked me.
And be right.
And be right. I know. So I don't know the answer to that one yet, in terms of the influencer deductions. And I know every influencer is taking those as expenses. And so it's just going to take some time to actually come out in court. And I'm saying this just because I know I'm sure there's plenty of influencers watching. And I don't want them to come back and say, hey, you told me that I could ride off that boat.
This is not financial advice.
That's right. But if you have we mentioned the mastermind event earlier. So, when you're putting on masterminds, it's important to get the right location, and the right locale.
Speakers.
And, it takes looking at a few different venues to make sure that you got the right one. So if you're putting on events and you've got to go look at a few venues, again, it comes back to, there's two things I'll say. Number one is pigs get fat, hogs get slaughtered. So if you try to get too aggressive, especially in these kind of gray zones, you could end up
slapped.
Yeah, exactly. And then, so that's the first one I would say. And then next I would say document. So bank statement versus pictures of receipts. That's just the very fundamental level. when you're going around looking at event locations and you're flying to places like St. Croix or Fiji or Amsterdam or Miami or wherever you're looking to put these events on, you've got to document when you went to the event, the event that or when you went to the location, the event that you're planning it for, the event coordinator that you met with to discuss, hopefully some pricing sheets that you actually got. You need to actually go do those things. On the yacht piece, I would say in your sales, let's say you are an influencer selling courses, maybe you have a sales process. And I'm just spitballing here. This is part of the whole thinking proactively and working one-on-one. Yeah. But like my thought process would be, let's say you're selling a $2,000 course and you have a salesperson discussing with the prospect on buying that course. If you can find some documentation or some language that prospect says that they saw that yacht post and that's why they linked, or if your ad is a yacht post and they click the link to the landing page directly from that yacht post, and you've got more traffic as a result of that compared to you sitting in an office doing a selfie in front of your desk, that would be that justification to me. So that's where if you're going that route of kind of lifestyle expenses being deductible, it is an absolute thing that you can do, but you've got to justify it and you've got to document it more and more and more. So none of this just bank statement stuff that'll get thrown out and absolutely slapped, to your point.
Okay. And last question. What happens? Someone starts, 8 months go by, they didn't get QuickBooks. They're just using bank statements. Who do they hire to go back and catch up, make every entry into QuickBooks after the fact?
Yeah. So that would still be like our firm or any accountant.
So if I hired you guys, I say, look, here's my bank statements. Here's everything that went in and out. Now I need you guys to go catch up my QuickBooks up to date.
Correct.
So now every dime you guys have to go ask me about.
So most, if it's Verizon or AT&T, we pretty much know it's cell phone bill, right? So what we do is you go over the last 8 months, and we can't go back and make receipts up out of thin air. Of
course.
So you lose a little bit of that documentation.
You roll dice.
Yeah, and what does Confucius say? Best time to plant a tree is 20 years ago. Second best time is today. So it's the same thing with taking pictures of receipts and documentation. But we go through and we categorize all the expenses that we're 99% sure of what they are. And then we give you a list of transactions and say, what are these? Tell us what they are.
Then you tell them.
And you tell them and you say, oh, that was a business expense. That was a personal expense that I accidentally put on the business card.
Yeah, because with me, it's like, you don't lie or you're going to get in trouble. Mm-hmm. But it just seems convenient if you're an actor, an influencer, like, hey, I'm going to make videos. So I have to go to St. Thomas to see if I want to make one there. Now, I was there 7 days. Well, was I really there for that? Yeah, I really was there for that. But I also freaking enjoyed life while I was there. That's not a problem. That's called convenient. Boy, that's convenient.
Right.
Well, yeah, it's convenient. Don't blame me. I picked this business.
Yeah.
So what business should people be picking to get more of that opportunity to where it's not a lie. It's just convenient. Like right now, dude, if I took you, if I said, hey, let's me and you go talk about this in Amsterdam.
Right.
That's legit, dude. Like, hey, I am considering you could write it off. I could write it off.
Right.
Now, the fact that, Brad's account was only going to be worth $8,000. Tyler, how did you, why'd you spend 80? Don't worry about it.
I thought it was going to be,
$8,000 times lifetime.
Right. And so,
but that's just convenient, you see?
Sure.
But that's legit. It's still legit.
Yeah, absolutely. And, I'll touch on the day's travel thing real quick, but to answer your question on what's the best business to be in, I would say any business that has the broader the client base, the more legitimate you could, justify those things, in terms of potential events, potential, attracting more and more people because, those lifestyle expenses appeal to a broader and broader group of people.
Well, I know a guy with 5 Ferraris and 2 Rolls Royces. I says, dude, do you really need that many cars? He says, it's marketing.
Yeah. So, and again, that's where the whole pigs get fat, hogs get slaughtered.
That's what he says, though. It's marketing.
And it's probably true.
I'm like, well, that's convenient.
How much more does that 4th car get him versus having the 3 cars?
Who's the judge?
And that's up to the auditor.
Is it up to the auditor?
It is up to the auditor and how good of a case you can make to tie that fourth or fifth car to the extra business, you know?
But, folks, my advice, and it's not financial advice, my advice is tell the fucking truth, right? And take advantage of opportunities where you can. And if you can't, you can't. Like, I know a guy that put on a birthday party for his daughter, 16-year-old daughter. Spent like $100,000. He said, that's marketing. I said, why? He said, I invited all my clients. I said, oh, that's convenient. But like, to me, I wouldn't pull shit like that, well, because that was a birthday party and he just happened to invite a few people that are
so how that would actually work is, let's say it was 200 people at the birthday party and 70 of them were clients. Well, you'd have your list, and this is how you actually hold up in an audit on these kinds of things. You'd have your attendee list. And you'd make a note, business relationship, personal relationship next to each of those.
Well, what if they're all potentially business relationships?
The 7-year-olds probably is a little tough to.
Oh, I got you.
You know what I mean?
You mean the friends?
The friends. Yeah. If all the friends and they're bringing their kids and there's one friend for each kid, then that means half of your attendees are your business associates. And so half that party, the meals portion of it, not the entertainment, if you have had a band or whatever, half that party would be deductible. As long as you discuss business with those people too. You see, you got to go around and be your social butterfly. But so that's the difference between just kind of writing it off and hoping it sticks versus having a plan to do it the right way. Just like with travel, you mentioned 7 days and I go have some fun. It matters that you do business on each of those days, because what they do is if you travel and over 50% of your business days are business, then 100% of your flight's deductible. If it's less than 50%, then none of your flight's deductible. And then the meals and hotel are based on the percentage of the date. So, and another strategy is if you work on a Friday and work on a Monday, then Saturday and Sunday count as business days, whether you go have fun on the yacht or whatever you do. And so planning it so maybe you arrive on a Wednesday and then leave on a Tuesday, and you've got your agenda of the business items you did on Thursday, Friday, and Monday, because the travel days, Wednesday and Tuesday, don't count towards the percentage. Then Saturday and Sunday, you go have fun, and you can have some fun part of those other days, and then it's 100% deductible. Versus if you flew in on a Monday, had some fun on Tuesday, worked Wednesday, Thursday, had fun Friday, and then flew home Monday, it would be only like 30% deductible, so none of the flight and only 30% of the hotel. And I know that was a whole bunch of numbers, but that's again, doing it the right way strategically, rather than just putting it all on the business card and hoping that when you get audited, it doesn't get thrown out.
How did you meet Tony and how did you get involved with that? Because he only has a couple firms, right? And
yeah, so we're one of two United States firms, and then he's got a firm in Australia, a firm in the United Kingdom. So
carefully selected.
Yes.
And the reason I'm asking is because a lot of people listening are going to be thinking, well, I just need to go get a CPA. Well, why should people say, no, you need to go get you?
Yeah. So it was a few years in the making. So back when I became business partners with my dad, he said, I don't want to take a cut and pay to bring you on as a partner. So let's grow this business. And so part of the growth strategy was to join some mastermind groups and kind of network through there. And I was in a mastermind group, and they asked me to teach a 13-week course on kind of taxes and personal finance. And I said, sounds great. And about half the attendees of that course were Canadian, because the mastermind was kind of split. And I don't know Canadian tax law. So I reached out in another group of CPAs that I was in and got connected with this Canadian CPA to come kind of be a guest. And he was at the time, the Canadian version of what I now am with Tony. And he told me about the program, Global Accounting Advisors, and said, you go to Business Mastery, and then Tony talks about the importance of getting a second opinion on your taxes. And then they come and you give them free tax assessments and save them money. And I was like, that sounds like something we'd be really good at. We're aligned. That's our philosophy. We were proactive at helping business owners. So he gave me the name of the Australian partner, who was the guy running it. And we cold emailed him and said, hey, we think we'd be a great fit. Here's our philosophy. He said, okay, great. Tell me about your business. And then we had a call scheduled, but he was in Australia. And so it was 10 o'clock at night our time. And we said, okay, we had it scheduled. And then a few days before the meeting, we said, hey, is there any way we could reschedule so that it overlaps our time? And I don't know why we were thinking that we wanted to reschedule, but so he said, sure. And 3 years later, we got our appointment.
3 years?
Yeah. So in the meantime, I started building my Instagram and my social media following, started giving a bunch of speeches, and we kept growing, and we built that muscle of growth. And Tony always teaches things happen for you, not to you. If we had gotten that partnership at the time that we were way smaller, we would not have been able to absorb what happens when you become partners with Tony Robbins to your business. So kept growing, kept building my social, developing my skills, wrote a couple Forbes articles, was staying in touch every 2-3 months. Hey, I'd love to see if we can get 15 minutes. Love to see if we can get 15 minutes. Here's an article I wrote for Forbes. Here's our Into It from the Future feature, etc. And then finally, three years later, almost to the day, got a reply from his assistant. Hey, Tyler, are you free for 15 minutes? And, we can hop on a call. And I said, yes, I don't care what time it is. And then he had, they did a little bit of background due diligence and said, hey, hop on a flight to Vegas Business Masteries in 2 weeks. Go check it out. It'll change your life. And then we went there, kind of worked out some things, talked with Tony's people, and he said, all right, if you want it, the partnership's yours.
Boom. And that must have got you a lot of business, because as you speak and teach, everyone's like, hey, can you be my CPA?
Yeah. And that was just the partnership. And absolutely, it got us a ton of business. And at that point, I wasn't speaking at Business Mastery. Yeah, it was, Paul was. And then we were partners for a couple years, and then COVID hit, and we ended up helping as all these PPP loans came out, and we started emailing our audience that we want to help you with PPP loans. One of those emails got forwarded to Tony's CFO, and they got an email from Tony's CFO saying, hey, tell me about what you're doing with these PPP loans. And I said, okay, I'll hop on the call, and Tony Robbins, CFO. And he said, okay, tell me. And so I said, we're helping consult on whether it makes sense to take them, what they can get, tax advantages. And he said, okay, great, and hung up. I said, okay, cool. That was sweet. I just, had a conversation. And then a couple hours later, I got a text from him. Hey, Tyler, are you free to hop on a Zoom call with Tony and me in 10 minutes? And I said, absolutely, I can do that. And then, so I did, and we kind of talked through, and at that point, Tony was familiar with who I was, but we didn't really have a super personal relationship. But he really liked the way that I communicated. And because I'd been, 3 years in front of a camera, talking about these kind of concepts, making them simple for people to understand, he said, I think this would be super helpful for business owners everywhere. Let's do a webinar to the entire country in 2 weeks. So Tony and I did a live webinar about almost a year ago today. And then because of COVID, the Australian partner couldn't fly out to speak at Business Mastery. And so I said, I'd love to throw my hat in the ring. And then I got the opportunity to speak at Business Mastery. It went well. And now I'm multi times kind of the slotted speaker for that event now.
Nice.
So it's been a journey.
Well, that's how you explain preparation, folks. You were prepared.
Yep.
Because you could have got that opportunity and blew it.
Absolutely.
Just as easily.
Yep.
Well, folks, you heard it. Tyler McBroom, just like it sounds. Go get his book, Cashflow and Grow. Go get yourself the CPA firm services. TylerMcBroom.com. Is that where it's at?
Yeah, they
it's
can go
called
there.
Measured Results.
Measured Results is our firm. If they go to taxsaversconsult.com, they can schedule a free appointment. But if they just go to TylerMcBroom.com, they'll be able to find it from there. That'd be the easiest thing to do.
And if you go to TylerMcBroom.com/Brad Lea, you're going to get the book for free.
That's right.
Tyler, I appreciate you showing up. Folks, share this out. If it's not for you, it might be for someone that you share it with. And until next time, keep it real.
Dropping bombs with the Real Brad Lea. Subscribe now.